Did you know that there's a little-known tax loophole that can save you a whopping $50,000 every year? Sounds too good to be true, but trust me, it's not. This loophole is a game-changer for digital nomads and remote workers, and I'm about to share it with you. As a digital nomad or remote worker, you're likely no stranger to the challenges of navigating complex tax laws. But what if I told you that there's a way to minimize your tax liability and keep more of your hard-earned money? In this video, you'll learn about a powerful tax loophole that can save you tens of thousands of dollars every year. You'll discover how to qualify for it, how to use it to build wealth, and the strategies that successful digital nomads use to maximize their savings. So, let's start with the basics. Understanding tax residency is key to unlocking this loophole. Most people don't realize that their tax residency is not necessarily determined by their citizenship or where they live. In fact, tax residency is often determined by where you spend most of your time. For example, if you're a digital nomad who spends most of your time in countries with low or no income tax, you may be able to claim non-resident status and save thousands of dollars in taxes. But how do you qualify for this loophole? It's not as complicated as you might think. Essentially, you need to demonstrate that you've spent less than 183 days in the country where you're claiming non-resident status. You'll also need to show that you have a permanent home in another country and that you're not just trying to avoid taxes. Here's the thing. This loophole is not just for the wealthy or sophisticated investors. Anyone can use it, as long as they're willing to do their research and follow the rules. Now, let's talk about strategies for minimizing your tax liability. One of the most effective ways to do this is by using a technique called tax deferral. Essentially, this means delaying your tax payments until a later date when your income is lower or you're in a lower tax bracket. For example, if you're a freelancer or entrepreneur, you may be able to defer your tax payments until the end of the year, when you've had a chance to reduce your taxable income. Think about this. If you can delay your tax payments by just a few months, you could save thousands of dollars in interest and penalties. But wait, it gets even better. There are many case studies of digital nomads who have successfully utilized this loophole to save tens of thousands of dollars in taxes. For example, one digital nomad I know was able to save over $30,000 in taxes by claiming non-resident status in the US and moving to a country with a lower tax rate. Another digital nomad was able to reduce his tax liability by over 50% by using a combination of tax deferral and income splitting. The key is to be proactive and strategic about your tax planning. So, what are the actionable steps you can take to implement this tax-saving strategy? First, you'll need to do your research and understand the tax laws in your country of residence. You may also want to consider consulting with a tax professional or financial advisor to get personalized advice. Next, you'll need to start tracking your days spent in each country and keeping records of your income and expenses. Finally, you'll need to file your tax returns and claim non-resident status, if eligible. It's not rocket science, but it does require some effort and planning. Most people don't realize that this loophole is not just for individuals, but also for businesses. If you're a business owner or entrepreneur, you may be able to save even more money in taxes by using a combination of tax deferral and income splitting. For example, you could set up a foreign corporation or limited liability company to hold your business assets and reduce your taxable income. The possibilities are endless, but the key is to be creative and think outside the box. But here's a bonus tip. This loophole is not just for tax savings, but also for building wealth. By reducing your tax liability, you'll have more money to invest in assets that generate passive income, such as real estate or stocks. Think about this. If you can save just $10,000 per year in taxes, that's $10,000 more that you can invest in your future. Over time, that can add up to tens of thousands of dollars in wealth. And here's another twist. This loophole is not just for digital nomads, but also for anyone who wants to reduce their tax liability. Whether you're a freelancer, entrepreneur, or employee, you can use this strategy to save money in taxes and build wealth. The key is to be proactive and strategic about your tax planning and to seek out professional advice if you need it. In conclusion, the $50,000 per year tax loophole is a game changer for digital nomads and remote workers. By understanding tax residency, qualifying for non-resident status, and using strategies like tax deferral and income splitting, You can save tens of thousands of dollars in taxes and build wealth. Remember, this loophole is not just for the wealthy or sophisticated investors, but for anyone who is willing to do their research and follow the rules. Thanks for watching. If you found this video helpful, be sure to like, subscribe, and comment below. And if you want to learn more about tax optimization and wealth building strategies, stay tuned for our next video, where we'll be covering the top 5 tax mistakes that digital nomads make. Don't forget to hit the notification bell so you can stay up to date on all our latest content.